Now, we
Wow.
can switch over to the Depression years, and in 1939, unemployment was 17.2%, and they didn't lie about the figures then. And I would consider that the U6 figure, which is 13.5% today, but that's a lie. So what we have to do is kind of guess what it really is, and I think a fair guess is 15%. So we're almost at the levels now on a U6 basis that we were in 1939 before Mr. Roosevelt arranged a war for us so that we could get out of the depression that was going on.
One of the things that you mentioned earlier was you're not looking for an Amero to come in, and I couldn't agree with you more. I don't see how they can do it right now. But you wrote something I'm going to quote from the International Forecaster that I found to be extraordinarily important. The U.S. can never recover unless trade tariffs on goods and services are implemented. Without that, America is doomed to be a second world nation, as is England. Even with tariffs, debt default has to happen, and it'll happen. It will occur within the next 3 years. No way out. This is why, during the inflationary and hyperinflationary period, you have to be almost totally in gold and silver-related assets, eventually only in gold bullion coins. So the trade tariffs on goods and services, are they going to be putting them up? I think they're going to be doing it all over the world as people are clamoring to protect any industry they have left. And, of course, our industry, manufacturing, has gone from 28% of gross domestic product down to 11%. We don't have much manufacturing left to protect, do we?
No, and that means we can't recover. So what will happen is that, and it's already begun, we have China, Russia, and some other countries have begun using tariffs, which they hadn't used before. And, of course, we're subsidizing General Motors and Chrysler, so that's a form of protection of industry, and just like protective tariffs are. And so we've begun as well. But what's going to happen is smaller nations, third worlds, the second-tier nations, are going to begin to charge tariffs and make bigger subsidies to their industries. It's going to spread. It's going to get worse than it is already for America, which can't compete because we don't have slave labor in America. And so the U.S. Congress will ultimately be forced to follow the lead of other nations in enacting tariffs officially. But that's not going to happen probably for 2 or 3 years. And it's going to happen at the same time probably that hyperinflation ends and real hardcore deflation and depression begin. I believe that we have begun depression in America. I predicted 2 years ago, as of 2 weeks from now, in February, 2 years ago, that we entered the recession. As far as I know, I'm the only one who did so, and I was right. Some people come by
you were
about
100%
a year later
correct
and said the same thing, but that's okay. The point is we're entering depression now, and it won't become visible for 2 or 3 or 4 years, depending upon when hyperinflation collapses.
Wow. Okay. Now, another couple or 3 years, this isn't a short-term situation by any means or shape. One of the things that you talk about, of course, you talk about the recession, which began 23 months ago. You were the only one calling it a recession, and now you're calling it a depression. The bond market. Now, you say the bond collapse would be a $100 trillion loss. The bond market's 10 times the size of the stock market. Now, tell us a little about the bond bubble, because I'm not too familiar about that, Mr. Chapman. That's something that I don't have bonds, and so I'm not familiar with it. Tell me about it.
Well, it's not the corporate bonds that we're talking about so much. It's the U.S. Treasuries. And what the Federal Reserve has done is they've rigged the interest rate market in Treasuries. And they've also done the same thing to LIBOR, London Interbank loans between banks, and
Right.
many of the lenders in America, throughout the world as well, use LIBOR rate to lend as a basis to lend against. They also use the U.S. 10-year note. And so what's been going on is that the Federal Reserve has run down interest rates on U.S. Treasuries where there's no yield on the 1 month. The 3 months probably got 0.05 of 1%, and the 6 months got probably 0.15, and so on. The rates are extraordinarily low. And the Fed's they're doing it, but there's a lot of people in there as well who perceive that the U.S. Treasuries are the safest thing in the world, and they're not. But be as it may, they only can eventually hold down for a long period of time the short-term paper, which is the paper that's 2 years and under. They really can't easily control the 5, 10, and 30-year markets. And I think later this year, probably around September, October, that the yield, which is 2.16% on a 10-year note right now, as of today, I think that will be 4%, and that will be compelling because that will start the ball rolling downward on the bond gains that we've seen over the last 20 years. And there was an article, front page in Barron's, saying that we're in a bond bubble, and they're right. The question is, when will it break? Don't know, but I'm projecting it later, and that would be September, October would be the beginnings of that. And they're also...
More when we get back. Well, you no longer have a friend in the diamond business. Shane Company's going broke. They're Chapter 11. Nortel's going under. They're Chapter 11. Huge company there. You've got lots and lots of companies that are going under right now, and situation's not looking good at all. That's in the U.S. twice a week on the International Forecaster. And one of those I want to talk about is Ireland. They're demolishing more houses than they're building in Ireland right now. You're expecting housing prices to drop 80%. We think we've got it bad. Is this a portent of what may be coming to America?
Well, I think in eventuality, yes, but you have to remember that house prices are leading the charge to the downside. And we also are going to see the stock market on the Dow basis, which is around 8,200 right now, probably go down to 6,000 this year and maybe even lower. And I think an ultimate goal for the Dow is probably 38 to 4,200. And we'll be lucky if it stops there.
Whoa.
So that means houses that in normal times without a depression, in a correction like we're having now, might go down an average of, say, 30%. And if you take in the 30 former hot areas, they would probably go down about 45%. But the value of everything except gold is going to go down anywhere between 60 and 90%. And, you know, when people say to me, what do I do? There's only one thing you can do. The only thing you can do. We're in hyperinflation right now. You buy gold and silver-related assets. We hit the peak, and deflation starts big time, which would mean the depression would be starting terrible rather than just beginning as it is now. Gold would be the only place to be. And all it has to do is hold its value. It doesn't have to go up because everything else is going down. So if you have gold and it only
You're talking about hyperinflation. Yeah, yes. Let me ask you this, Mr. Chapman. You're talking about hyperinflation, and we're seeing that most people now are talking about deflation. And the reason is, I can see it both ways. We're putting so much money into the system that the money's got to be inflating. There's no question it has to be, but it's not really getting in the system. It's just being transferred to pay off fictional debts that have been raised by these various banks. That's the only place where the money seems to be going. However, when we're talking about hyperinflation versus deflation, if people don't buy, then prices don't go up. If people aren't buying, and people simply haven't got the money, they're losing their jobs, they're not buying anything. So are we not into a temporary, at least, deflationary period?
Well, we've been in a deflationary period for over 5 years, and they've offset that by increasing money and credit. And
right.
So in that process of the depreciating value of things, assets, that they have created a money and credit to the tune of probably around 14% average. And most of the major central banks have been doing the same thing.